Hello and welcome to our latest Talking Sustainability podcast. I'm Tom Marchson, an associate in the tax department at Travers Smith, and today I'm joined by Laura Hodgson, a knowledge counsel in our team, for the second episode in our podcast series on the topic of substance. Our regular listeners will know that in our first episode on substance, Laura and I explored the meaning of substance, why it's important for taxpayers, and how you can demonstrate it in practice using the Jersey substance rules as a case study. In this episode, we'll be discussing a very recent policy proposal on the topic of substance, the EU's draft directive targeting the misuse of shell companies, also referred to as ATAD 3. These proposals were still at a consultation stage at the time of recording of our last episode, but were released as a draft directive just before Christmas. In essence, the unshelling proposals are designed to introduce a common minimum substance test across all EU member states that, if breached, would trigger certain adverse tax consequences, such as the unshelled entities being unable to benefit from double tax treaties. The proposals also seek to introduce new information reporting requirements on substance, which extend not only to entities caught by the directive, but also those deemed to be at risk of having inadequate amounts of substance. Although the use of the term shell in the title of the directive may, for many, connote entities engaged in tax avoidance or so-called letterbox companies with no substance at all, the basic scope of the directive is fairly wide, with no revenue or de minimis thresholds, potentially catching many holding companies commonly used in business structures. The timeline for implementation of the proposals is also ambitious. They should be implemented by member states by the 30th of June 2023 to take effect on the 1st of January 2024. This might still seem some way off, but unhelpfully for taxpayers, the rules contain a 2-year look-back period, which means businesses will need to start thinking about these proposals well in advance of formal adoption by member states. So, in the remainder of this episode, Laura and I will be looking to explore 3 key things. First, which entities are within the scope of the rules. Second, how EU entities can demonstrate a minimum level of substance. And third, what businesses can do now to help prepare themselves for the rules. Laura, before we get into the detail of the draft directive, could you talk our listeners through how the directive is structured, as I think this will be important in helping them follow our discussion?
Yes, I think the first thing to note is that the draft directive only applies to shell entities that are tax resident in an EU member state.
Okay, so it wouldn't have any impact on entities with inadequate substance in, say, the Channel Islands?
Exactly, it just applies to EU entities. And by entity, what I mean is any undertaking that is tax resident in the EU. So this measure isn't limited to companies. ATAD 3 is structured as a 5-step process. Step 1 is the gateway test, and this sifts out any entities that are not at risk of having inadequate substance. And this leaves at-risk entities, which then go through the gateway and move on to the next steps.
Okay, so just pausing you there, Laura, you don't want to go through the gateway, that's a bad thing.
Correct. As an entity, you definitely don't want to go through the gateway. If you don't go through the gateway, you are considered to have sufficient substance and you are out of the rules completely. So going back to these 5 steps, the second step is that the at-risk entities, these are those entities that have gone through the gateway, will have an annual obligation to report whether or not they meet the minimum level of substance. Entities who meet the minimum substance requirements are presumed not to be shell entities, and they are out of the rules at this point. Although, as we will discuss later, they will still need to satisfy this Step 2 annual reporting obligation. Entities who are unable to meet the minimum substance requirements are presumed to be shell entities and have to proceed to the third step. The third step gives these entities the opportunity to supply further information in order to rebut the shell entity presumption. If the entities cannot rebut the shell presumption, then they move on to Step 4. At Step 4, there is another opportunity for entities to get out of the rules, and they do this by claiming an exemption. This is a final possible so-called get out of jail free card. Finally, at Step 5, there are tax consequences for entities that are presumed to be shells and are unable to either rebut the presumption or claim an exemption. So these are those entities that couldn't get out of the rules under Steps 1 to 4.